So firstly, I would say whoever's watching, don't invest in anything which is not quality. You're not going to have a strong economic recovery endlessly. We're not China where you'll have 20 years of 9% growth non-stop, right? We have entered a cyclical downturn. Going into this economic downturn, high quality companies are actually far more reasonably valued than I've seen them in the last 4 years or so. Across large and small caps, quality I think will correct less than low quality names which had a blockbuster run through 22 and 23. If you go back 10 years, 20 years, classical in India, going into an economic slowdown, you tend to see IT services, pharmaceuticals and FMCG do well. And these are great opportunities, I think, for long-term investors. If an economy kept rising every year, right, your ability to figure out when to get in is lower. But if you can see that fundamentally the country is in great shape, fundamentally India is in great shape because corporate balance sheets are in great shape.
Hi guys, we have with us Saurabh Mukherjea. He is the founder of Marcellus Investment Managers. He is well known for his coffee can investing style that focuses on high quality companies for long-term investment. Hi Saurabh, how are you doing?
Hi Riti, I'm fine. Thank you very much for hosting me.
Thanks for making time for us.
My pleasure.
So let's dive right into it. So you come across as an introvert. How do you balance it with your work?
The introversion was a very painful thing to deal with. I remember in school, in class 8, there was a debate where you had to stand up and speak in front of the whole school or entire class 8, around 250 boys staring at me. And I had stage fright. I couldn't open my mouth. And this was, I think I was 12 or 13 years old. And that's when I told myself that however much I have this problem with introversion, what I'll train myself to do is speak clearly in front of other people. So I think I was 13 years old and I created this sort of goal in life to be able to speak clearly in front of large audiences. So ironically, the introversion itself led to this desire that through my teenage years, through my university years, I kept looking for public speaking opportunities to get over this stage fright. I think so far so good. I think managed to get over the most of it. But even now, the introversion gets in the way of building relationships with, say, other people in our industry, building relationships with management teams, because partly related to introversion is the social skills probably aren't as good as I would like them to be. Thankfully, I married a woman who's got superior social skills. So at least in our, when we go to parties, my wife takes care of my introversion to a significant extent.
That's quite interesting. How did you get introduced to stock market? And is there any incident that stood out for you?
Believe it or not, I didn't really know about this whole concept about equity research and fund management. I really had no idea about it. I graduated from university. I was working for one of my professors, Sir John K. And a friend of mine, Nicola Arnold, her name is. Nicola told me that there's this thing called CFA. So I said, "Kya hota hai?" And she showed me the CFA website and I enrolled for the CFA program. I passed a couple of levels and this is 2001, 2002. That's when I realized there's something called equity research. That's when I realized there's something called fund management. So it was I think at the age of 22 or 23 that I became aware of the possibilities of analyzing companies and then investing in them. And had it not been for Nikki Arnold, perhaps I would have never come across this whole concept. At university, I was very much a geeky student, and then, as I said, I graduated from university and started working for Sir John K., who's a prominent economist. So the introduction came to the stock market in my early 20s. Perhaps if somebody had been introduced me to the stock market when I was 11 or 12, perhaps I would have been a better investor.
A very early investor, actually.
Early investor. Practice makes perfect. So 10 more years in the market might have given me other points of view.
Yeah. So, talking more about your investing style, how has it evolved over the years as you've gained experience?
Every stage of my career, if I look back, I've been doing this now for roughly 20, 22 years. Every stage of my career, I've learned something, implemented it, done well out of it, then made some mistakes. And then the mistakes then help you finesse what you do. So if I look back at my years in the UK of covering UK small cap stocks, I was very much a disciple of, say, Peter Lynch, right? And Peter Lynch's books are about growth at a reasonable price, PEG ratios, and so on and so forth. And I drank that Kool-Aid and became well known in the UK for doing that. Thankfully, I was able to predict the Lehman crisis. So I think it was February 2007. We wrote a 50-pager on how the British financial system will blow up. But as the financial system blew up, both in Britain and America, that's when I realized that valuations are often deceptive. This whole notion that something is looking cheap on PEG or growth at a reasonable price, it's deceptive because ultimately under deep duress, it's only quality which holds up. And then the refinement of that took place after I moved to India. That's when the whole coffee can investing construct arose, that quality matters, especially in a country where institutions are weak, where corporate governance can be uneven. You overpay for quality because that helps you go through tough times better. Then we learned post-COVID that if you overpay for quality, then you suffer, right? We suffered badly through 2022 and the first 3 months of 23. Marcellus suffered badly, and that then taught us again that yes, you want companies which are high quality, both from a corporate governance perspective and from a franchise perspective, but you also have to be careful that you don't get over invested in quality, because if you do, and interest rates go up 5%, you will be taken out on a stretcher. So we have refined again over the last 18 months. We've refined again, and that's borne fruit. We're outperforming again. So every stage of your life, you learn something, you build it, you tweak your philosophy, you do well, but inevitably the market is clever. It catches up with you. You make a few mistakes and you correct again. I think that's part of the charm of the job. If you see that as the charm of the job, you're able to learn from your mistakes and make yourself a better investor.
So you kept plugging in the leaks, as in
yeah, nicely put. Yeah, so you got a boat. You're in the high seas. Every few years, the boat springs a leak. You plug it, and the boat moves further on in the deep seas of investing. Nicely put.
So also, so now that we look at Nifty, it's been in a very tight range. So what's your take on the markets at these levels? Do you also see a correction looming around the corner?
Before we get to the valuation and the corrections piece, I think what's worth highlighting is we had a supercharged economic boom in India post-COVID, right? So 2022, 23, and the opening months of 24, the best part of 2.5 years, India has a really strong economic recovery. As everybody knows, we became the world's fastest growing large economy. And free markets move in cycles. You're not going to have a strong economic recovery endlessly. We're not China, where you'll have 20 years of 9% growth non-stop, right? So I think we have entered a cyclical downturn. The results for the quarter ending June 2024 were weak. I think the results for the quarter ending September 24 are going to be weaker still. In that context of the economy entering a cyclical down cycle, in that context, the valuations at the Nifty level do appear to be rich, and I would suggest a correction at the overall index level over the next 6 months or so.
If we talk about the broader market, in the past 1 month, although Nifty is in a very narrow range, even the broader market indices have been in that same tight range. Though if we look at the past 1 year performance, the mid and small cap indices have given almost double the returns of the benchmark. Also, there seems to be, there are pockets which are quite overvalued as well in the broader market. So what's your perspective on the mid and small cap stocks? Do you find value there as well?
So look, I think as we discussed, if you're going to have a correction in the broader market, which I think is more likely than not, given that the economy seems to have entered a cyclical downturn. If we have a correction in the broader market, it stands to reason that small and mid caps will correct more than large caps, given that small and mid caps rose more than large caps, right? That being said, our job is to find clean, high quality companies, and it's been in a way, now I turn to the good luck that we enjoy. Because through 22, 23, and even the early months of 24, until 6 months ago, quality really wasn't doing well. So you basically had a 2.5 year period, starting with the Russian invasion of Ukraine in Jan 22. Right? You had 2.5 year period where quality took a back seat, and low quality companies had a great run. As a result, going into this economic downturn, high quality companies are actually far more reasonably valued than I've seen them in the last 4 years or so. So I think to find HDFC Bank or Asian Paints at these valuations, you'll have to go back a long time. So my reading is, yes, the economy seems to be softening. I think the earnings that have emerged in this quarter so far clearly point to a softening in the economy. And yes, therefore, the broader market seems likely to correct. But I think large caps will correct less than small caps. And across the piece, across large and small caps, quality I think will correct less than low quality names which had a blockbuster run through 22 and 23.
So, if I ask you, what would be a smart investment option among large cap, mid cap, and small caps? You would go for large
So
caps.
if you said like for like quality, so you say I create three. So firstly, I would say whoever's watching, don't invest in anything which is not quality. Right now, you can interpret quality your own way, Mr. or Mrs. Viewer. You can interpret quality your own way, but don't invest in companies where the books aren't clean. The promoter's track record of high quality capital allocation isn't well established, and the balance sheet isn't rock solid, right? Now, if you then say, look, Saurabh, here's three portfolios, large, small, and mid, each of them high quality, which one would you go for? I would unquestionably say, go for large caps in this sort of circumstance.
But then, would you still see the kind of growth potential as compared to like the other mid small cap stocks? Or also, if large caps have been giving like double digit returns, do you see that continuing in large caps? If you're saying let's choose large caps probably.
So I think two aspects to understand that. Firstly, in many cases, high quality large caps are trading at record low PE multiples, right? So for example, HDFC Bank, which is one of our largest positions, is trading at a record low PE multiple. And from that perspective, from a valuation re-rating perspective, I think high quality large caps potentially have a steeper valuation re-rating ahead of them than high quality small caps, right? So that's the first piece. Secondly, given that many of the large caps in our country are still relatively small in the context of their sectors, right? So, for example, Titan's market share in the jewelry sector would be less than 10%, right? Titan's compounded 1000x in 20 years, but even today, its market share in the jewelry sector is less than 10%. And as everybody knows, gold demand is ripping through in India. Similarly, HDFC Bank, even though it's twice the size of Citigroup, HDFC Bank is twice the size of Citigroup today. HDFC Bank's market share in India is just 12%. So many large caps are still very small in the context of colossal sectors. So I'm not so sure that there is going to be a massive growth discount. And I think it's reasonably clear in many of the high quality large caps, the valuation re-rating that lies ahead of them is potentially steeper than what you'll see in high quality small caps. And just a quick disclaimer, all these stocks are parts of our portfolio. I'm invested in our portfolios. So are my parents, and obviously so are our clients.
So, since we spoke about financials and Asian Paints consumer discretionary, which are the sectors that you're bullish and bearish on for the upcoming Samvat year?
I think we'll see a classical setup again. Classical in India, if you go back 10 years, 20 years, classical in India going into an economic slowdown, you tend to see IT services, pharmaceuticals, and FMCG do well. I think for a whole bunch of reasons, I think these three sectors are in good shape. In IT services case, the American rate cutting cycle has begun. In FMCG's case, I think the government, after the 4th June verdict, the government has become far more proactive in giving SOPs and subsidies to the poor. And in the case of pharma, both the demand coming from the Western world and the fact that the Chinese are banging down the prices of raw materials which go into pharmaceuticals, puts the pharma sector in a good place. So I think IT, pharma, FMCG going into a classical economic downturn should be good safe harbors. And within those sectors, look for well-run, clean, high-quality companies with stellar track records of capital allocation.
It's very interesting that you pointed out that the economy is going into a cyclical downturn. Could you elaborate a little more on that? Because so what we've heard so far and what people are speaking about is that the transformational phase of India, and that's it is only going to go higher from here. So your view is slightly different from what others are saying. Yeah. Can you elaborate?
So structurally, India is in good shape. Indeed, we've actually published a book which is going to get published on 21st October called Behold the Leviathan, the Unusual Rise of Modern India, and that's your copy. Hopefully you'll enjoy reading it over the Diwali break.
Thank you.
So we've published a book on India's structural rise. So structurally, India will be ascendant. But remember, in a structural story as well, there will be an economic cycle around that. And the reasons for economic cycles are always the same. Classically, three things drive economic cycles. Firstly, if you have interest rates which have gone up with a 1.5 year lag, the higher interest rates slow down the economy. So if you think about it, the Federal Reserve hiked rates through 2022 and 2023. Even the early months of 23, the Fed was hiking. And the RBI also followed suit. Thankfully, not as much as the Fed, but the RBI also hiked meaningfully. And therefore, with the 12-month lag, you're seeing the effects of those higher rates feed through. Already in the first quarter results, you had banks and NBFCs reporting higher NPAs. I think that will continue into the second quarter, right? So that's the first reason. To dampen economic growth, central banks hike rates, and then with a lag, that has a dampening effect on growth. The second piece is fiscal stimulus, right? So through COVID, the Western governments gave massive fiscal stimuli. Then as we came out of COVID, they removed the fiscal stimuli. And similarly, in our case, our government didn't give as big a fiscal stimulus as the Western countries did, but India too supported the economy through various measures. So if you remember, ECLGS was a nice measure to support SMEs. As those fiscal buffers, as those fiscal stimuli which held the economy up, they get taken out quite rightfully. Fiscally also, you take some steam out of the economy, right? So monetary policy tightens, it exerts a down force in the economy. Fiscal policy tightens, it exerts a deflationary force in the economy. And finally, the job cycle. You're bound to go through cycles in a free market economy of lots of job creation. We had that in the early years after COVID. I thought, even 21 actually, 21, 22, 23 were super for job creation. The job creation cycle seems to have tempered a little bit in the last few months. And all three factors, I think, are contributing to a cyclical slowdown. And these are great opportunities, I think, for long-term investors. If an economy kept rising every year, right, your ability to figure out when to get in is lower. But if you can see that fundamentally the country is in great shape, fundamentally India is in great shape because corporate balance sheets are in great shape, banking system balance sheets are in great shape, affluent households are financially in great shape. Financialization is afoot in the country. Structurally, India is in great shape, but cyclically, we're going to go through a downturn. I think that creates lovely opportunities to get into high-quality companies at sensible valuations, which is exactly what we are doing, which is what we have done. And thankfully, in the last few months, the results are coming through again.
So you see ample opportunities in terms of creating alpha right now.
Yeah, I think if you ask me that, for a style of investing like ours, which focuses on quality, which focuses on high quality governance, great franchises, and steady growth, I think for our style of investing, in fact, the alpha has started coming through nicely over the last 6 months. And both my hope and my reading of the situation is the next few years bode well for Marcellus.
So there is a bit of sector rotation that's happening. Are there any other interesting trends that you probably may have observed?
I think one trend I think we're likely to see in the next couple of years is the amount of retail money that's come into the market, I think feels a little over the top. So I think the latest SEBI data is saying 170 million demat accounts in the country. And the latest income tax returns data suggests 20 million Indians are paying income tax. The filers are more. I think filers are 80 million, but people paying IT is around 20 million. And this disconnect between 20 million people paying income tax and 170 million demat accounts suggests to me that a huge ecosystem of first-time retail investors without particularly deep pockets has come into the market. And I suspect they were to come into the market into the most overheated stocks. I suspect they're going to pay the price for that, and therefore, in that regard, there will be churn in the investor base that drives the Indian market.
So basically, now you probably are hinting that DIIs and FIIs could take the baton from here on. Is it?
I'll be astonished if retail investors take the baton from this point in. I think they've done a great job, but it just feels the number of retail investors. I think 4 years ago we had 30 million. Today we have 170 million. That's 6x, 5.5x explosion. Feels a little excessive for a country where just 20 million actually people pay income tax.
So what should investors expect in terms of returns at this point in time? Especially, that the returns have been quite stellar in the past few years, after COVID specifically.
So depending again on your style of investing. So if you let's take it step by step. Remember that the Nifty over the last 40 years has compounded. Sorry, not Nifty. Nifty's only been around for 30 years. But say Sensex over the last 40 years has compounded by around 12-13%. So if you've been through a phase of 25% returns, then naturally a degree of mean reversion there feels warranted, right? And on forward PE multiples, the Indian market is trading at record levels, and therefore I think a mean reversion from 23, 24 times forward PE at the large cap index level back to 17, 18 would seem warranted. But by the same token, if you reverse the argument, if you've invested in high quality companies whose earnings growth has been pretty steady around the high teens mark over the last 3 years, but compounding has barely been low double digits, right? Earnings were compounding at 19, 20, but share prices were compounding at 10, 11. I think there'll be a degree of mean reversion there as well. So I think at the index level, we're likely to see, at best low teens returns for a whilst the economy the economy goes through a cyclical downturn. I think at the index level, low teens returns. But for quality companies, I think with earnings compounding being mid-teens combined with some re-rating, I think there's a high possibility that for high quality companies, you will see high teens returns. And that's the alpha that you referenced a few minutes ago.
Since you mentioned about the cyclical downturn, should investors focus on steady returns or superior returns?
I think that tortoise versus hare story, I think we all learned that in primary school. I think that probably remains the best parable for investing. You can try to be the hare if you want. I haven't had those aspirations historically. I think the folks at Marcellus are happy being the tortoise. And it's very interesting, right? At any point in time, as in the Aesop fable, it feels that the hare is going to kill it. But ultimately the tortoise wins. So it amuses me no end, the application of this parable to investing. So we started Marcellus and we started investing clients' money on 1st December 2018, right? And we've had good years and we've had bad years. Net of fees, we've beaten the index by the best part of 100 bips, in spite of a torrid time through 22 and 23. So it's very interesting, right? The tortoise style of investing, both the companies, the tortoise companies, the Titans, the Asian Paints, the HDFC banks, they seem to be perpetually tortoises. And yet you look back and you say Titan has compounded 1000x in 20 years. Asian Paints, I think, is compounded 24,000x in 40 years. And the hare is nowhere in sight.
So I'm quite curious about your book. Could you tell us a little more about that? It says the unusual rise of modern India. Any themes that you've picked up from here?
So look, I think what stunned us when we came out of COVID and we started traveling again, right? For 1.5 years, we were all cooped up at home. And when we started traveling after COVID, it almost felt like we were traveling in a new country. And those travels led to stock ideas, which then came into the portfolio. The portfolio started performing better again. A couple of years ago, our friends at Penguin reached out and said, why don't you turn your newsletters on how India is changing? Why don't you turn them into a book? And that's how the idea was born. So for example, one of the things we realized as we started traveling after COVID is because women are now better educated than men. So at school, college and university, there are more women studying than men. The pass rates for the women are far higher than the pass rates for men. Increasingly, the best jobs, not just in offices, but also in factories, the best jobs are going to women, which in turn is translating into wealth, right? So 2 years ago, for the first time, the Reserve Bank of India data showed that in urban areas, women have more money in their bank accounts than men. First time in Indian history, in cities, women's bank accounts had more money than men. RBI data also showed that women have more bank accounts than men. So the balance is higher, the number of accounts is higher, and then a number of banks publish data that the default rates for women buyers are far lower. So that's when we said there's a huge opportunity here. Women are getting educated, they're getting jobs, they're getting wealthy, and therefore that in turn led to us tripling our position in Trent 1.5 years ago. Trent in turn tripled on us that point in, right? So that's the power of understanding the country from your perspective, right? Normal person will say, India is a patriarchal society, men have the money, right? Our travel suggested otherwise, then the data from the RBI suggested otherwise. We then turned those insights into an investment idea. which has done wonderfully well for us. Let's hope Trent continues prospering for many years. And in a way, the book is an amalgam of those path-breaking ideas which gave us some of our best investment ideas. So, for example, another idea in the book is the rise of non-IIT, non-IIM, non-overseas educated people. So, once again, 2 years ago, for the first time, we realized that for the first time in Indian history, the majority of the board directors of the Nifty 50 companies were neither from IIT nor IIM nor overseas educated. The local graduate was the guy or girl running the show now, right? So we then said, if that's the case, if there's a new elite rising, people who are not of the kind to sort of sit and drink a gin and tonic at the Bombay Gymkhana or speak the Queen's English, people who are comfortable in the vernacular, their wealth and their spending habits will be very different from, say, anglicized folks, right? They'll want to show off their wealth. It's a very human thing to want to display status. But the way they'll display status will be very different from the way someone who's educated in an elite institution and speaks the Queen's English displays status, right? That in turn led to investments in CCP, in our large cap portfolio in Royal Enfield, in Eicher Motors, and in our small cap portfolios in, say, a company like Carousel, which makes quartz sinks, right? So India has changed dramatically. The most fascinating thing about the change is many people in India don't realize how India has changed in the last decade or so, which opens up both an opportunity for us to share interesting insights, but more relevantly, it opens opportunities for us to make money for our clients.
Quite interesting. Actually, I remember when we last spoke, you also mentioned something about the Southern Peninsula and the states.
That's right. Yeah, your memory is very sharp, Deepthi. So what we highlight in the book, and again, this was a result of us clocking it whilst traveling, is that today the 7 peninsular states, right, and I'm including Maharashtra as a peninsular state here, Maharashtra, Karnataka, Goa, Kerala, Tamil Nadu, Telangana, Andhra. The 7 peninsular states account for a quarter of India's population, half of GDP, and 2/3 of GDP growth. So a small part of the country, just 1/4 of the population accounts for 2/3 of the growth. So this part of India is the world's fastest growing region. This part of India has grown over the last 10 years at 8%, and I think highly likely will grow at 8-9%. Now imagine, right, if a part of the country grows at 8-9% in real terms, that means in nominal terms, adding inflation, it's growing at 14-15. If that geography itself is growing at 15, high quality companies there will be growing comfortably at 20%, right? So again, doubling down, over-indexing on peninsular India makes sense from an investment perspective. And whether it is a Titan, whether it is a Titan less so, it's Trent, which is over, Zudio specifically within Trent. Zudio is the affordable clothing proposition which is over-indexed, or say Southern India centric lenders like Cholamandalam, which is again a big part of consistent compounders. They're allowing you to translate superior economics into investment results in the portfolio. So behold the Leviathan, the unusual rise of modern India is about how the country is changing, and then the translation of that change into investment opportunities for people like us.
Very exciting.
Oh, thank you.
Is there any advice that you would want to give our viewers? So
look, I mean, the temptation in our job, the temptation in investing is when the going is good and the market is superheated, everybody wants to sell their house and put it into the stock market, all of that. I think the next few months are going to be ulta, right? The next few months will feel, I think, fairly choppy. Our view is that the best opportunities to invest in India will come, I think, over the next few months, especially the early months of 2025. The economy is softening, but structurally the economy is in super shape. Digital infrastructure, physical infrastructure, corporate balance sheets, banking system balance sheets. Structurally the economy is in great shape, and I think those opportunities that will arise over the next 6 months as earnings weaken, earnings soften, I think should be made the most of. As the legendary Warren Buffett says, be greedy when others are fearful. So it was an intriguing conversation with you, Saurabh. Thanks, Deepthi. I hope you guys also find this quite helpful to take you all forward in this investing journey. Happy Diwali and thanks for watching.